and we're going to go over long-term assets. Now, the big key with this chapter is really talking about depreciation. And so we're going to spend a lot of our time discussing depreciation and how that works. So in this chapter, we're going to talk about long-term assets and determine how we value them, and then how we allocate depreciation for those periods. Because remember, an asset's going to last us over a year. Because of that, we treat it as a long-term asset. But in order to take a cost each year, because we're using up that asset, we treat it as depreciation. So we're going to talk about different ways of depreciating assets. We're going to talk about what all is involved in the cost of assets. And then we're going to look at some various methods of depreciating. And then what do we do when we get rid of those assets, or what we call dispose of those assets? We'll also take some time and look at assets that are related to depletion. So timber. Timber is an asset, but timber is on a big piece of land that we cut down those trees. So how do we allocate that asset as it relates to using it up, natural resources? Another type of asset can be a landfill. Think about a landfill. You can only put so much trash into a landfill. And so how do we account for using up that landfill? After a period of time, that landfill is, when I say not worthless, but we can't put any more trash in that landfill. And so how do we account for that? And then we'll also talk about intangible assets, such as goodwill, items we purchase that have a value, but you can't really see it, intangibles. Valuation. Now, we've continued to talk about this concept of valuation throughout the last Principles 1 and now Principles 2. Valuation is assigning a monetary value to business transactions and the resulting assets and liabilities. The one thing we know about valuation is we generally assign the value of what we paid for something or what we have into something. So if this desk retails for $300, but we purchased it for $100, what are we going to value this desk at? $100. Why? But it's really worth $300. Why will we just do $100? You're right, but we'll only do $100 because that's the proof we show that we paid for the desk. So we're going to talk about valuation of assets. We're going to talk about where we classify them. Remember, the one thing we've learned is we have accounts under the chart of accounts. And all of these accounts, are unique to specific items. We classify assets into the corresponding accounts, such as if we're dealing with an automobile, we'll have it under vehicles or automobiles. If we're dealing with land, we're going to put that under land. If we're dealing with business assets like machinery, equipment, we'll put them under those correct categories. So we're going to talk about the various classifications of fixed assets. Then we're going to talk about the periods in which, even though we purchased the asset in this period, we might not necessarily pay for that whole asset in this period. And so we're going to show the asset when we have received it, not necessarily when we pay for an item. And then disclosure relates to the items that we need to spell out in our financial statements that help users understand the assets we have. And recognition is about what period do we record certain assets. So we're going to spend Chapter 10 really delving into assets. I think actually you're going to enjoy this chapter. It really is going to be fairly straightforward. Long-term assets that we're going to talk about have certain characteristics. The characteristics of long-term assets include a useful life of greater than 1 year. They're used in operating the business. For an asset to be classified as property, plant, and equipment, it must be put in use, which means it's available for its intended purpose. So let's say we purchase a building and we have a year's worth of renovations on that building. It won't be treated as property, plant, and equipment until it's available to be used. So it may be treated as a building for investment purposes, and we'll add our renovations into that until that building is ready for use as the way we intended it to. So we'll still have it as a long-term asset. We may have to put it in another category until it's ready to be used. Another example, let's say we purchase a $200,000 big like waste management truck, but we have 3 months of work to do on that truck to get it into service. We won't put it right away into property, plant, and equipment until it's ready for the use, the intended use of why we bought it. We'll put it into an asset category, but we won't actually start depreciating it until we're ready to do so. Assets that are not used in the normal course of business, such as land held for speculative reasons or buildings no longer used in normal operations, get classified as investments. They're still assets, but they're going to be located in a different spot on the balance sheet. They are not intended, long-term assets are not intended to be resold to customers. Okay? Inventory is resold to customers. An asset that a company intends to resell to customers should be classified as inventory, not as a long-term plant asset. For example, we are dealing with a builder, a home builder, who builds homes for customers for their job. In that scenario, the homes that they are building would be inventory. They would not be a long-term asset because that home isn't being used in the ordinary course of business. That home is being manufactured in order to be resold. So in that scenario, those homes would be inventory. Does that make sense? Now, as you can see here, long-term assets is a percentage of total assets for certain industries. Computer and peripheral equipment manufacturing companies, 78% of their long-term assets are total assets for the company. Then we look at industrial machining manufacturing, 66% of their long-term assets constitute their total assets. Scheduled air transportation, 75% of their long-term assets total their total assets. Then we've got advertising agencies that are going to be less, grocery stores a little less, clothing stores are the biggest, or I should say constitute the smallest percent of long-term assets to their total assets. This really makes sense because if you think of manufacturing businesses, they probably have a lot of equipment that's utilized in manufacturing their products, and as a result of that are heavy with long-term assets. I'm actually surprised that the air transportation is only 75% of their total assets. That lets me know that their accounts receivable and maybe some goodwill that they have. In this day and age, there's so much merging of companies that oftentimes when one company purchases another, they end up with goodwill on their balance sheet. So maybe some of their intangible assets can be significant to help come up with their total assets. But this gives you a list of how important long-term assets are to companies and why we're talking about it today. So a long-term asset is discussed as property, plant, and equipment land and other long-term assets that have a physical substance. So they have value and they're tangible. Natural resources are assets purchased for the economic value that get extracted from them, such as oil and gas or timber, for that matter. So we may purchase long-term assets such as a timberland because our goal is to take the timber off of it. And so really we're dealing with depletion and another type of depreciation or amortization. Intangible assets don't have a physical substance, but they still have value. Copyrights, patents, goodwill, those are items that companies will purchase in order to conduct business. So let's think of a patent as far as a pharmaceutical company. A lot of pharmaceutical companies will create their own drugs, but oftentimes they'll purchase the right to utilize or to manufacture that drug. And so if you think of Viagra, Viagra is a big deal right now. It's not generic because it's still in that patent stage of 15 years. And so if a company purchases the right to sell Viagra, there is an intangible benefit because it's got value. Does that make sense? So they purchased the right, the patent, in order to manufacture and sell this Viagra. So in order for a company to be able to have that benefit to sell it and manufacture it, usually has to purchase it because it definitely has a value. That value, even though you can't see it, has a worth and will generally amortize it over the period of its useful life. Okay? And the reason it has a value is a patent gives that person, the person who has that ability to produce it, the only person that's technically allowed to produce it until that patent is no longer, and then it goes open to the market to be generic. Do you understand what I'm saying? There's a lot of antidepressants out there that at one time, like Lexapro, only the person who had the patent to Lexapro could manufacture it. So in order to purchase a month's supply, it was like $250. Now it's generic, so a lot of people are out there producing it. Now it costs $40. So do you see the value that patent had? They were able to raise the price because they were the market. It's supply and demand. They were the only ones able to produce it, therefore it had a value. Under accrual accounting, the cost of these assets, with the exception of land and maybe some intangible assets, are allocated to the periods in which they benefit. So this depreciation we're going to talk about, is going to be allocated to certain equipment over their useful life. We never can depreciate land because we consider land having an unlimited life. Now we can depreciate the things or show depletion for the items on the land or down in the land, like mineral rights, which we'll talk about. But the actual land, we say, has an indefinite life. Okay? So we can't depreciate it. Some people would say that that's controversial. So for example, we have farmland. Now the farmland has a lot of erosion, you know, and has items that do wear over time. But generally speaking, land becomes more valuable throughout the years. It doesn't lose value. Does that make sense? That's why we can't ever depreciate land. Allocating the cost of natural resources, instead of calling that depreciation, we're going to call it depletion. And then those intangible assets like goodwill or patents or copyrights, instead of calling that depreciation, we call that amortization. So it's the same concept. It's where we take a piece of their long-term life and allocate it for that current period, and we call them different things depending on what kind of asset it is. So for fixed assets, we call them depreciation. For natural resources such as oil or gas, we call that depletion. And then for intangible assets, we're going to call that amortization. So, if you look on a balance sheet, I don't know how well you can see that because it's kind of small. We show long-term assets, and we have three broad categories of these long-term assets. One is called property, plant, and equipment. These are assets that we use in the business operations, land and plant assets. Land is not expensed because it has an unlimited life, but the other items such as plant, buildings, equipment, all of those will be allocated as depreciation over their useful life. Then natural resources, mines, timberland, oil and gas, we will deplete over its useful life or until it's getting used up. And then intangible assets, we're going to amortize over their useful life. Long-term assets are reported and valued at the carrying value. Now, what we mean by carrying value is the value we purchased them for minus the allocated or accrued depreciation, accumulated depreciation we've already taken on it. So the difference, the building less the accumulated depreciation equals the net, or what we call the carrying value of the plant assets. Mines, the same way. We treat them at carrying value. The cost of the mines minus what we've already taken in depletion on those mines. That net amount is called carrying value. Same with our intangibles. We show what we initially purchased them for less any amortization we've taken all to date. Gives us our carrying value on those intangibles. If a long-term asset loses some or all of its potential to generate revenue before the end of its useful life, we call it it's become impaired, which means the carrying value of that asset gets reduced. So there are times when we may have a long-term asset and we thought that we are using the appropriate useful life of that asset. But for whatever reason, the asset doesn't have the value we once thought it should have. We call it that it gets impaired. And so we need to correct the new fair market value to what it actually is. It's going to be less than what we show on our books, the carrying value. So fair value is the amount which the asset could be bought or sold for in a normal market. And if we show on our books the carrying value to be higher than that, we need to adjust for that impairment value. Remember, it's always important to remember that we never want to overstate our assets. So the reason we handle and we do this method or this procedure here is because we want to always be conservative and only show assets at the lower of cost or fair market value. In this case, the fair market value is lower than what we show on the books. That's why we have to treat it as an impairment. Now, expenditures are payments or obligations to make a future payment for an asset or a service. Expenditures get classified as capital expenditures or revenue expenditures. So for a capital expenditure, it's purchasing or expanding a long-term asset. So when we call it a capital expenditure, it's basically purchasing or maybe renovating an asset that's still going to have a useful life of greater than a year. We record any capital expenditures as an asset. We add it to our fixed assets because it's going to last longer than a year. That's why we treat it as such and then depreciate it. Revenue expenditures is for the ordinary repairs and maintenance needed to keep a long-term asset in good operating condition. In that case, the revenue expenditures get expensed each year. So, for example, we have a big asset that manufactures computers. Well, a part broke, and we need to pay someone to come in and fix it. Those are just normal repairs on assets. So that type of repair is called a revenue expenditure, which we're just going to expense right away. It's not going to necessarily prolong the life of the asset. It's just keeping it current, keeping it maintained. So we know that that gets expensed in the current year, but capital expenditures to improve the longevity, to enhance it in some manner, if that lasts us longer than the current operating cycle, we're going to have to depreciate that extra capital expenditure. Items like for capital expenditures are outlays for plant assets, natural resources, and intangible assets. Enhancements are additions to the physical layout of a plant asset, or ways to improve it, we call betterments, ways to improve a plant asset, but not in addition to the plant's physical layout. All of these type of capital expenditures prolong the use, the life of the asset. Therefore, as a result, and it's going to last longer than the year. As a result of that, we're going to treat them as an asset. We'll add it to our asset and depreciate it. Extraordinary repairs, repairs that significantly enhance a plant's asset's estimated useful life or residual value, are going to also get capitalized or added to our fixed assets. So the key here is normal wear and tear fixing is an expense in the current period. Okay? We're just trying to keep it up to date, keep it maintained, keep it, going. But items that enhance the asset, that's going to allow it to last longer, that's going to give it a lot more capabilities or increase production, will get capitalized or added to the asset account. So let's talk about the difference between these two items. So here's a good example. Excuse me. Example, the purchase of a machine that will benefit a company for several years is mistakenly recorded as a revenue expense. Now what they're trying to say is it mistakenly got put as an expense instead of a capitalized expenditure. Okay? What happens if they mistakenly did that? The total cost of the machine becomes an expense on the income statement in the current period. As a result of putting it all as an expense, the current net income will be reported at a lower amount. Okay? It's going to be understated. And in future periods, net income is going to be at a higher amount because we won't have something to depreciate each year. It all got depreciated in 1 year. Okay? But it's going to last us for several years, and so we're really not allocating the use of that asset in the current period. We expensed it all in the first year. Therefore, we took a bigger expense in one period, showed a lower net income, and as a result, in the future periods, we had nothing else to depreciate because we expensed it all in 1 year, and as a result, we end up with higher income. Now, in this case, revenue expenditure was incorrectly recorded as an asset. So maintenance, repairs on an asset. A revenue expenditure such as routine overhaul of a piece of machinery gets charged as an asset account. What happens? If it is getting charged as an asset, that increases our assets and incorrectly and decreases our expenses incorrectly. So our expenses get understated, which means our net income is higher than it really should be. And the net income of future periods gets understated because what's happened is we then, in the future, are going to depreciate a portion of that when we really should have just expensed it all in one period. So we need to make sure that we handle these various types of transactions appropriate so we don't mess up the appropriate accounting for these transactions. Okay. Now what we're going to do is talk about how we determine what we purchase an item for, and then we're going to look at various methods of being able to depreciate items. So, the acquisition cost of property, plant, and equipment include all expenditures reasonable and necessary to get an asset in place and ready for use. So, the asset price is going to equal what we purchased it for, plus any additional expenditures, such as shipping it to us, paying for the installation of the asset, sales tax on the asset, whatever we needed to do to get it in service. Interest charges incurred in purchasing an asset are not a cost of the asset, but an operating expense. So the interest that we pay on purchasing an asset, we expense in the current period. If we purchase an asset and we have a year to overhaul it, then those interest charges during that year that we're overhauling it get added to the basis of it. But just interest in order to purchase an asset get expensed each year. Small expenditures for long-term assets can be treated as expenses if they're not material. So if items are small in amount, just write them off. Each company has its unique determination of what is a small item, but generally speaking, I would say with most companies, if the item is under $1,000, it's generally just going to be expensed in that period because you're going to be dealing with a lot of transactions adding on to that asset. But it's different for different companies. Expenditures that should be debited to the land account include the purchase price of the land, commissions to real estate agents, lawyers' fees, accrued taxes paid by the purchaser, cost of preparing the land to build on, such as cost of tearing down old buildings and grading the land, assessments for local improvements, and landscaping. So all these items, when you purchase land, in that price isn't just the purchase price of the land, but it's the commissions paid to the agents, lawyers' fees, the title company, title. A lot of times people have to buy title insurance, accrued taxes if they had to pay some taxes in order to purchase the land, preparation of the land, improvements, everything to do with that land is going to get added to that asset. Here's an example. Assume that a company pays $340,000 for land, $16,000 in brokerage and legal fees, $20,000 to have an old building on the site torn down, and $2,000 to have the site graded. It receives $8,000 in salvage from the old building. The cost of the land is $370,000. The way we determine that the cost of the land is $370,000, not just $340,000, is $340,000 is what we paid for the land. But in addition, we had these extra capital expenditures such as brokerage fees of $16,000, $20,000 to have the building torn down. But since we received $8,000 for that building that was torn down, it really nets us $12,000 there. Because we paid $20,000, we got $8,000 out of the deal. It's really a loss or a cost of $12,000. grading the land, all of it totals $370,000. Does that make sense? Some improvements to real estate, such as driveways, parking lots, and fences, have a limited life, and we can depreciate those. Think of a driveway. The driveway has to constantly be maintained or improved, and so that can be depreciated. Parking lots are constantly needing to be redone. Fences also. So items, even though they're on the land, it's a structure on the land, we can depreciate those because they are limited in their life. Even our gravel driveway, every couple years we have to go and spend a couple $1,000s just to put more gravel down because it wears down, it falls off the road. You know, it just, once you put it down, it's not going to last forever like land is. Improvements to real estate, all are going to have limited lives. They're recorded in an account called land improvements. So this won't be part of land. Land improvements are going to be separate, and we're going to be able to depreciate those. When a company buys a building, the cost includes the purchase price of that building and all expenditures required to put the building into usable condition. When a company constructs its own building, then in that case the costs include cost of materials, labor, overhead, architect's fees, lawyer's fees, insurance during the construction, interest on the construction loan only during the construction, building permits, everything it costs to build, all the expenditures in building this building are going to be added to the cost of the building. Improvements to lease property, such as installing carpet or walls on the books of the leasee that become the property of the leaseor, at the end of the lease are called leasehold improvements. Something we'll talk about down the road here. Now, equipment. All the expenditures to purchase equipment and preparing it for use get added to the cost of that equipment. The invoice price of purchasing the equipment, less any discounts we took, the freight or the shipping, if we have to pay insurance in the shipping, sales tax, tariffs, whatever it costs to get it into the country, any expenses to buy it and install it and get it tested in order to run, all that gets added to that equipment. Sometimes companies purchase land and other assets for a lump sum. The purchase price has to be allocated between the land and the other assets. So here's an example. Suppose a company buys a building and land for $170,000. Its appraisal yields estimates of $20,000 for the land and $180,000 for the building. So they're telling us we bought it for $170,000. But the estimates we get show $20,000 for the land, $180,000 for the building. That totals $200,000. So technically, 10% of the price is going to be allocated for land. 90% of it's going to be allocated for the building. Okay, let's take a moment and look at some problems. Okay? How's everyone doing so far? Okay. So, first thing we're going to look at E4A. Unless I find a better one. E1A. Let's start with E1A. Okay? Okay. E1A. Tell whether each of the following transactions related to an office building is a revenue expenditure or a capital expenditure. Now remember, a revenue expenditure gets expensed in the current period. A capital expenditure is going to get added to the asset. In addition, indicate whether each transaction is an ordinary repair, an extraordinary repair, an addition, a betterment, or none of these. Now, what do we know about ordinary repairs? Won't those be revenue expenditures? It's the only kind of revenue expenditure we're going to have, right? So if it's a revenue expenditure, it's going to be an ordinary repair. If they're a capital expenditure, they could be an extraordinary repair, an addition, or a betterment, right? Number one, the hallways and ceilings in the building are repainted at a cost of $4,150. What do you think painting would be? Ordinary repair. I agree. It would be a revenue expenditure and it would be an ordinary repair. Is that going to improve the longevity? Is it going to enhance it? It's going to make it look better. Number two, the hallways which have tile floors are carpeted at a cost of $14,000. Extraordinary repair. Okay, let's go back real quick to, I want to look at the various betterment. Okay, do you see here it talks about additions are enlargements to the physical layout of a plant asset. Betterments are improvements to a plant asset, but not an addition to the plant's physical layout. Extraordinary repairs are repairs that significantly enhance a plant asset's estimated useful life. So this honestly is a little confusing, but I'm going to help you along the way. These hallways, tile floors are carpeted at a cost of $14,000 is considered a betterment. Okay? Number three, a new wing is added to the building at a cost of $87,500. What would that be? Addition. Furniture is purchased for the entrance to the building at a cost of $8,250. Does that have anything to do with this building? No, none of these. Okay? Now that furniture would be a capital improvement or capital expenditure. It would be a fixed asset. It just wouldn't be part of this building, right? It'd just be property, plant, and equipment. Or furniture. Property, plant, and equipment under furniture. Number five, the air conditioning system is overhauled at a cost of $14,250. The overhaul extends the useful life of the air conditioning system by 10 years. So let's go back here. Would it be an addition? No. Would it be a betterment? Kind of. But this is an extraordinary repair. Repair that significantly enhances a plant's assets' estimated useful life. It's an extraordinary repair. Okay? Next, a cleaning firm is paid $100 per week to clean the newly installed carpets. Hello? Does that improve the building? What are they doing? This is just kind of a cleaning expense, isn't it? So it's none of the above. It's just a revenue expenditure of a cleaning expense. Do you ever see these people in here come and empty the trash and clean? It happens every week, so it's just maintaining. Make sense? Okay. Let's look at E2A. Is this okay with you guys that we're going through some of these? I think sometimes this is helpful. Actually, I want you to spend Fraser Manufacturing purchased land next to its factory to be used as a parking lot. The following expenditures were incurred by the company. Purchase price, $300,000. Broker's fees, $24,000. Title search and other fees, $2,200. Demolition of a cottage on the property, $8,000. General grading of the property, $4,200. Paving the parking lot, $40,000. Lights for the parking lot, $32,000. Signs for the parking lot, $6,400. Determine the amount that should be debited to the land account and the amount that should be debited to the land improvements account. So let's go look at this. Okay. What do you think about for the land account, guys? What do we start with? Land account. I'm sorry, what? Purchase price? What's how much? $300,000. What's next? What do you think? Here, I'm going to do land account, and then I'm going to do land improvement. What else? What do you think about the broker fees? Land account? What about title search and other fees? What about demolition? What about grading? It is, but you know what? Technically, you could probably go for either. Okay. But since the book says land account, we're going to listen to the book. Okay. So the land amount would be $338,400. Now, what about paving the parking lot? What about lighting? What about signs? $78,400 would go for our land improvements, and that would all be able to be depreciated. And the land account of $338,400 would not be depreciated, would it? Land can never be depreciated. Let's look at E3A. Or, excuse me. Yep, E3A. Sea Scout purchased a car wash for $240,000. It purchased separately the land. It purchased separately. If purchased separately, the land would have cost $60,000, the building $135,000, and the equipment $105,000. Determine the amount that should be recorded in the new business's records for land, building, and equipment. So I want you to take 3 minutes and try to figure this out on your own. Okay, let's take a look at this. Let's figure out the percentages we're going to use. The first item is the land. How much if purchased separately would it be? Then the building would be how much? Then the equipment. So all of this totals $300,000. So, whoops. So 20% would be the land portion, 45% would be the building, the equipment would be 35%. So how much did they purchase it for? $240. So if we know that the real value is $240, then what we'll want to do is take these appropriate percentages by the purchase amount, right? Whoops. So $48,000 would be allocated to the land, $108,000 would be allocated to the building, and the equipment would be $84,000. How many of you guys follow that? That make sense? Now let's look at E4A. E4A tells us Melissa Mertz purchased a used tractor for $17,500. Before the tractor could be used, it required new tires, which cost $1,100, and an overhaul, which cost $1,400. Its first tank of fuel cost $75. The tractor is expected to last 6 years and has a residual value of $2,000. That means once it's all said and done, what will they sell it for? Sometimes it's called a salvage value or a residual value. Determine the cost and the depreciable cost of the tractor and calculate the first year's depreciation under the straight line method. Okay, we're going to start talking about something that we haven't breached on first. So when we deal with the straight line method, we have to take into account what the cost is minus the salvage value. So let's go back here and look at that. So depreciation is what we do to allocate the cost of this asset over its useful life, not to the asset's physical deterioration or to its decrease in market value. This is just because we're using the asset and it wears and tears, how much are we going to depreciate it each year? The major factors that limit a depreciable asset's useful life include physical deterioration, the use or exposure to the elements, obsolescence, going out of style or out of date. Depreciation gets recorded even if an asset increases in value. So the way we compute depreciation is we take into account the cost plus everything to get it ready. Then from that we subtract the residual value, which we can call the salvage value, the trade-in value, the disposal value, which is the portion of the asset's cost that a company expects to recover when it disposes the asset. So we're not going to depreciate that portion because we know that's what it's going to be worth. The depreciable cost is going to be the asset's cost minus that residual value. Then from there we'll figure out the useful life of the asset. And we'll take the total number of units, be it in years or production, expected from the long-term asset, and divide it by those specific amounts. So what we'll do is we'll determine, based on the end of each year, we'll take that portion of depreciation as a depreciation expense, and we'll credit that accumulated depreciation or that contra account to offset it, to show ultimately its carrying value. So the straight line method, which is pretty straightforward, is the asset's depreciable cost gets spread evenly over the estimated life of the asset. It's based on the assumption that the depreciation happens as a result of just time. The way we calculate the depreciation is by taking the cost of the asset minus that residual value or disposal value, divided it by the estimated useful life. So let's go back to our E4A and look at this problem. Melissa Murch purchased a used tractor for $17,500. Before the tractor could be used, it needed new tires and an overhaul of $1,400. Its first tank of fuel was $75. Do we care about $75 of fuel? Does that improve its value? No. It's just the first of many tanks. The tractor is expected to last 6 years and have a residual value of $2,000. So we have to determine the cost and the depreciation. So let's start with the cost of the tractor. What's the first thing we're going to take, guys? Purchase price of how much? $17,500. What are we going to add to it? New tires for $1,100. What else? Overhaul, $1,400. So our total cost here is going to be $20,000. What is the residual value? So we are not residual value. We're not going to depreciate the residual value. So the depreciable cost is going to be the 18 minus the 2,000, or 18,000, isn't it? What is the useful life? So won't we take 18,000, 6-year useful life? So the difference of 18,000 divided by 6 years, won't our depreciation be $3,000 per year? Does that make sense? Okay. So we looked here, that is called the straight line method. It's pretty straightforward. So as you see here, based on the carrying value, at the end of each year, the accumulated depreciation, or the amount we took each year, goes against the carrying value, and at the end of whatever year, in this case, we have 5 years of depreciation. At the end of the 5 years, we're ultimately going to end up with the residual value on our books. There's another method called the units of production method. Now, instead of taking over 6 years, we do it based on how this machine is being used. So basically in this method, let's say we run a machinery so many hours a year, we'll depreciate it based on the number of hours that year we ran it. So it may fluctuate each year depending on how many hours we use something or whatever that factor is. Under the production method, we're going to take the cost minus the residual value, just like we did in the straight line method, and we'll divide it by whatever that unit is. Estimated units of a useful life. So think of this. If we think a truck is going to last us 150,000 miles, and we went 17,000 miles on that truck, we will divide that by that percent of 17,000 divided by what we think the useful life is of 150. So instead of doing it a fixed amount each year, we're doing it based on some type of production. So in this scenario, assume that the delivery truck in this example has an estimated useful life of 90,000 miles. In this case, our 18,000 depreciable value divided by 90,000 miles means we're going to depreciate this truck 20 cents per mile. Okay? So, if the truck were driven 20,000 miles in the first year, 30,000 in the second, 10 in the third, 20 in the fourth, and 10 in the fifth, then what we'd do is, at the end of the first year, we would take depreciation of $4,000 bucks, which is 20,000 miles times 20 cents a mile. In the next year, we would take 20 cents a mile times 10,000 miles, right? In the next year, we would, 30,000. In the third year, it's 10,000 miles. The fourth, it's 20,000 miles. But basically, instead of just taking a flat amount each year, we're going to base our depreciation on the use we've had on it, some type of unit of output. And so this is going to fluctuate based on the output we've had in this piece of equipment. This is another way that we can depreciate assets because when we use them, we're depreciating them. Another method is called the accelerated method. The concept here with the accelerated method is that assets lose more of their value in those first couple years than they do in later years. So we basically take a greater depreciation in the bigger years or the newest years, and then as the asset gets older, we take a lot smaller depreciation. We call this method the double declining balance method or the declining balance method. Oh, yep, it's called the double declining. That's how I knew it. This is where we accelerate the depreciation. So we'll look at an example of how to do this one also. In this example, an asset is good for 5 years, then the normal depreciation using straight line would be 20%. But we'll double it. So 2 times 20%, and we'll take 40% of depreciation in the first year. So we'll take 40% of depreciation in the first year, come up with a new carrying value. Now here's the key. When you use this double declining method, we will then only take 40% of the carrying value. So with the first year, the carrying value was 20,000, so we're going to take 40% of 20 to give us depreciation of 8. Our new carrying value at the end of the first year is 12,000. we're going to take 12,000 times 40%, come up with 4,800, gives us a new carrying value. See, at the end of each year, we take 40% times the carrying value, not the initial cost. But we always want to end up with our residual value here. So I want to show you, let's go back and go through some examples. Okay? Let's see here. Let's do E5A. It's a perfect one to do. On January 13th of 2013, Precision Oil Company purchased a drilling truck for $90,000. Precision expects the truck to last 5 years or 200,000 miles with an estimated residual value of $15,000 at the end of that time. During 2014, the truck has driven 48,000 miles. Precision's year end is December 31st. Compute the depreciation for 2014 under these following methods, and we'll prepare the journal entries. So, let's go here and let's look at how we're going to do this. What is the cost of this truck? $90,000. Cost is $90,000. What is the residual value? So the depreciable cost is the difference between, $75,000, right? Now, if we compute it by the straight line method, the straight line method means how many years will it last? Won't we take the cost divided by 5 years? Or we would take 75,000 divided by the number of years, or 15,000 each year? Wouldn't we do that? So, to follow that example, cost, carrying value. In the first year, we would have depreciation of 15,000. The new carrying value is 75,000. Oops. So this is year 1, year 2, year 3, year 4, year 5. Do you see at the end of year 5, our carrying value left on our books is our residual value? Right? This is using the straight line method, isn't it? After the 5th year, we won't depreciate it anymore because we fully depreciated it, because we plan on being able to make $15,000 when we sell this used up asset. So the $15,000 minus the residual value won't have a gain or a loss, which we'll talk about disposing of them. Okay? Now, let's look at the production method. Under the production method, it tells us we anticipate the truck to go for 200,000 miles. During 2014, the truck has driven 48,000 miles. Okay? So, in year 2, on January 13th, purchased the truck. Precision expects the truck to last 5 years. So in this example, we're just going to determine how much we would take for depreciation in 2014. It went 48,000 miles, and we anticipate it to go for 200,000 miles, right? So 48,000 miles divided by 200,000 miles. So how much is the truck? 90 minus the residual value, 75. And won't we depreciate it in the second year? 48,000 divided by 200,000? Or wouldn't that be, we would take 75,000 and we would divide it by 48 divided by 200, or wouldn't it be the depreciation? No, that doesn't sound right. So 48,000 divided by 200,000, 24 cents a mile. So 48,000 times 24 cents a mile, would it be 11,520? No, I'm not doing something right. 24 cents a mile, right? So 24 cents a mile $75,000 times 48,000 divided by 200. So what I'm screwing up on is the 48 divided by 200 is the percent, or 24% is what we need to take in the second year. So 24% of 75,000, because we've already gone 24% of the mileage. Do you see what I'm saying? So it's not 24 cents a mile, it'd be 24%. Gives us 18,000 is what we would be taking in that second year. Does that make sense? Now let's look at the double declining method. Under the double declining, we don't care about how many miles we take in each year.
So year 3, you don't know year 3 until you go through year 3, and then you add up all the miles.
So in year 3, they're telling us in year 2, we went 48,000 miles. Let's just say in year 3, we went 12,000 miles. We take 12,000 miles divided by 200,000 miles, okay, and come up with a percent equals, times, so we would take 75,000 times, we would take 4,500, okay, in year 3, because we're basing it on the number of miles we went in that year divided by 200,000 miles. Does that make sense? Now, if we're trying to accumulate it all together, that would be different, but all we're wanting to know is how much depreciation are we taking in that year? From the original, this is the cost minus the residual value. Okay? Under this method. And things can change. Let's say in year 2, we determine that the useful life is 200,000 miles. It could happen that in year 3, we change the mileage. We no longer think it's going to be 200,000 miles. It may be only 150. So we may have to adjust it, but we're not there yet. Okay? Now, the next method is the double declining method. The double declining method, which means we think this is going to last us 5 years. Under the straight line method, that means we take 20% a year, right? But what we're going to do under the double declining method is we are going to accelerate our depreciation. The one thing under the double declining method is we don't subtract the residual value, okay? So we start by the full amount, or 90,000, and we're going to take 40%, and we're going to have depreciation of 36,000. So our carrying value at the end of year 1 is going to be 90,000 minus our 36,000, or 54,000. Then at the year 2, our carrying value starts at 54,000. We're going to again depreciate 40%. What? Because under the double declining method, instead of taking, this is going to last us 5 years. Under straight line, that means 20% each year. Under the double declining, we double it. So we double it, but we're only then going to multiply that by the carrying value. Okay? So in year 2, we're going to multiply 40% times the carrying value of 54,000. And then we update our carrying value. You see, we started at 90,000. We took 40% in year 1, which was 36,000. We ended up at the end of the year with a carrying value of 54,000. And then in year 2, we began with 54,000. We multiplied it times 40%. That's at 21,600. We have a new carrying value at the end of year 2 of 32,400. You see how fast it goes down? Then in year 3, we start with 32,400. We are going to then depreciate, take 40% of 32,400, which is 12,960. Whoops. Which means the value is going to be 32,400 minus our 12,960, or 19,440. Now here's the key, guys. What do we need to depreciate it by? The residual value is 15,000. So we want to be careful that we don't go below our 15,000, okay? So ultimately, under this method, if we don't want to go under 15,000, in year 4, when we take our 19,440, we're going to multiply that times 40%. What is 19,440 times 40%? 7776. But guys, guess what? That's going to go below our carrying value, isn't it? You see how that's going to go to 11,664? What's our residual value? We have to keep this at 15. So we will only, in year 4, take the amount that gets us to 15,000 or 4440. See what we're doing there? Under the straight line, we took the residual value out of our calculation, so we just knew how much to depreciate each period. Under the double declining method, we don't subtract out our residual value. We double the number we would normally take under straight line. We come up with a carrying value at the end of the year. We still multiply it by that same amount, but we only multiply that 40% by our new carrying value. But whatever our residual value is, we don't want to depreciate below it. Does that make sense? Okay. So, let's go back and look.
Is that how you would write it? Because the last it was just 40% of 19,000 and then you wrote 4,000.
Correct. The reason I did that,
Is that how you write it?
well, because I can't go below this, so I might make a note. Note, only can take 4440 to reach residual value. See what I'm saying? Does that make sense, guys? Let's look. I'm going to let you do problem 1 on your own for homework. I want you to look at problem 3. Let's just do part 1 right now of problem 3. Okay? Is that okay? Ziegler Manufacturing Company purchased a robot for $720,000 at the beginning of year 1. The robot has an estimated useful life of 4 years and an estimated residual value of $60,000. The robot, which should last 20,000 hours, was operated 6,000 hours in year 1, 8,000 hours in year 2, 4,000 hours in year 3, and 2,000 hours in year 4. Now, we only care about those hours when we deal with production method. Compute the annual depreciation and carrying value for the robot for each year, assuming the different methods. Now, we know when we deal with straight line and production, we're going to take the depreciable cost, or the cost minus the residual value, and only depreciate based on that. If we do the double declining method, we take the full cost. We don't worry about the depreciable value until the very end. We don't want to go below 60,000, right? So I want you to spend 5 minutes going through the straight line, the production method for each year, and try the double declining balance. Okay? Don't worry about number 2 yet. We're only worrying about part 1, going through those 3 methods. As you see in the problem, you've got, for problem 3, the straight line method. So the first thing you can do here is show straight line method. Whoops. So as you see here, I want you to set up your sheet. I don't know what they have on your sheet for you, so I'm going to show you how to do this. I want you to set it up like this. See how it shows depreciation table, straight line method, year 1, year 2, year 3, year 4, but you've got to determine the cost minus the residual value, and that's what you're going to depreciate it over. So I want you to kind of look at this. Try not to copy it. Do you know what I'm saying? Because I want you to try on your own, but you have this up here to help you with, okay? Does that make sense? Try it on your own. But one says the robot was purchased for $720,000 at the beginning of year 1. The robot had an estimated useful life of 4 years and a residual value of 60. The robot should last 20,000 hours, was operated 6,000 hours in year 1, 8,000 hours in year 2, 4,000 hours in year 3, and 2,000 hours in year 4. So if we look at the method for straight line, in year 1, we're going to take the depreciable value by what we purchased it for minus the residual value is our 660. Straight line, it doesn't matter the units of production, it's just divided by the 4 years. So in the first year, the second year, the third year, and the fourth year, each year we're going to take depreciation of $165,000. Our carrying value at the end of the first year is our cost in it minus our depreciation, $555. The second year, it's going to be the end of the year 1's carrying value minus depreciation gives us $390 is our carrying value at the end of year 2. At the end of year 3, our carrying value is going to be the end of year 2's carrying value of $390 minus $165, or $225. Then at the end of year 4, our carrying value should be our residual value of $60,000. Now, when we use the units of production method, we're just calculating how many units were used up in each period. So in year 1, we had 6,000 units divided by 20. So that's going to be, or hours, whatever it was. We're going to take that ratio times the depreciable cost of 660. We come up with 198. So our cost of 722 minus our 720 minus our 198 gives us a carrying value of 522. In year 2, we had 8,000 units minus 20,000, which is the total number of units or hours, gives us a ratio or a percent. 660 times that ratio of roughly 2.5, right? It gives us our 264,000. We take our year 1 ending year carrying value minus this depreciation to come up with the new carrying value. In year 3, we have 4,000 units out of 20,000 units, which would be, year 2 I said 20-some percent. That's actually about, how many, it's got to be about 35% on that one. In year 3, we're going to take the ratio of 4,000 units over 20,000 units, multiply that times the depreciable cost of $660 to come up with the $132. Our year 2 ending carrying value of $258 minus our $132 gives us a new carrying value of $126. And then in our last year, we're only going to have 10%. So $660 at 10%, or $66,000. We take that, the year 3 carrying value minus our depreciation of $66 gives us our carrying value at the end of year 4 should equal our residual value. Okay? So we know with the straight line method and the units of production method, we always will end up with our carrying value. And we always utilize for our depreciable value, it's going to be the cost minus our residual value is what we're going to use. It's different under declining method. Under declining method, we're going to start with our cost. We know at the end of year 4 we need our carrying value to be $60,000. We cannot go below it. So at the end of year 1, what we'll do under the double declining method, this is a 4-year asset. Normally we depreciate it by 25%, okay? But under double declining, we multiply that times 2. So whereas we normally take 25% over straight line, 25% times 2, we're going to take 50% of the value. So in the first year, 50% of $720,000 or $360,000 means our carrying value is the $720 minus the $360 or $360. For year 2, we're going to use that carrying value, put it at the beginning here, times 50% or $180. We come up with a new carrying value at the end of the year of $180. In year 3, we're going to use that $180 to determine how we depreciate it at double declining. That's $90,000. So at the end of year 3, our carrying value on the books is $90,000. That's what we're going to use to start year 4. Now we know we have to end up with $60,000. So that means we can't take $45,000, which would have been 50% of $90,000. We can only take enough to bring it down to $60,000. Or we can only take $30,000. Okay? So you can see it's very accentuated and accelerated, I should say, at the beginning first couple years, and then it really goes down after that. So if you look at the straight line method, 165 is spread evenly. Under the double declining, you see we more than doubled it in the first year. But after year 2, years 3 and 4 are significantly less. The thinking being that the asset is really depreciated greatly in those first couple years, which makes some sense. Quite honestly, I don't know how significant, but that makes sense. Now, the next thing which we want to look at says, if the robot is sold for $750,000 after year 2, what would be the gain or loss under each method? Okay? So we know the sale of the robot is going to be what we sell it for minus our carrying value, correct? So if we look here under each method, under the first method, straight line, at the end of year 2, the carrying value is $390,000, isn't it? See $390? So $750 minus our carrying value of $390 would mean we would have a gain of $360,000 on selling that robot at the end of year 2. If we use the units of production method, at the end of year 2, our carrying value is $258, isn't it? So if we sell it for $750 minus $258, we would have a gain of $492,000. But look at C. If we sell it for $750, at the end of year 2, our carrying value is only $180. So in that respect, we would have a gain of $570,000. Okay? So the depreciation allows us to take an expense for using up those assets each period of time. But depending on what we sell it for, we may have to add back a gain. Does that make sense? Okay. P4 is just like what we did with P3, but I do want to go over P5 because this is doing the depletion, and I just want you to be able to touch on how this works, okay? You guys cool with that? Does anyone need a break? Yes, no? Bathroom break? Let's take a bathroom break.